Okay, so now we have understood the first major change that was there in the labor laws, which impacts gratuity valuation, is the change in definition of wages. So to conclude, how it will impact gratuity and leave and other non-statutory benefits, we'll see firstly for gratuity, the new qualifying wages will result in a one-time increase in the past service liabilities. So from the date of joining until 21st November 2025, which was the introduction, the implementation date, all the past service will get reinstated on the new qualifying wages. This would be a part of income statement, would be a P&L item because it is governed by a change in statutory law and amendment. And the implications, how that will further go, will depend on the applicable accounting standard which the company is uh, using, like AS 15, Ind AS, or US GAAP. So we'll discuss shortly how it would be different in all the three accounting standards. There would be also ongoing impact because now year in year additional current service cost, which is my recurring cost, would be computed on a higher base, the reinstated salary. So with one-time impact for all the past service, the year-on-year cost will also get increased. For leave and other non-statutory benefits, the increase in liability due to change in restructured salary will result in an increase in cost, and that will be an income statement impact. For leave and other non-statutory benefits, other long-term benefits, we know there is no concept of other comprehensive income OCI. So everything is a P&L or an income statement item. Moving on to the next slide. Okay, so as of now, we have discussed the first major change. Let's now move to the second change, which is the change in the vesting condition. Here, the vesting condition change has been introduced for two segments. We'll first look at the fixed term employees. Gratuity is now payable to employees engaged on fixed term employment upon the end of contract period. There is no condition for a continuous service of 5 years for this segment of employee. The routine employees remains unimpacted due to the change in vesting conditions. So for routine regular employees, the 5-year condition still stays the same. Here by fixed term employees, we mean all those employees who are hired on a fixed duration employment contract. This is a significant change for entities who hire a lot of fixed term employees. And from actuarial and accounting point of view, the additional liability arising due to this change is again a past service cost, and this cost will be recognized in the income statement. Next slide. The second segment where the vesting condition is getting changed is for the journalist employees. For the journalist employees, now the vesting condition of 5 years have been changed to 3 years. This change impacts companies who are in news and media sector, and the change of 3 years will result in increased liability, which would be an income statement impact. And how that income statement impact will come under different accounting standards will be covered very shortly. Next slide. Yeah, so from here, I'll request Khushwan to take it forward.
Thanks, Surbhi. This is an interesting one. Until now, we were all thinking that impact will only be on gratuity, but not on leave. But that's not true. There will be impact on leave as well, and let's understand how. For this, we need to go into the OSH code and look at the definition of worker. it states that any person employed who's a worker, any person employed in any establishment to do any manual, unskilled, skilled, technical, operational, clerical, or supervisory work for hire or reward except employees in managerial and administrative roles and employees in supervisory roles with wages above 18,000 per month. So this definition has resulted in a lot of queries coming to us. A lot of companies are asking that can now white collar employees be considered workers? Well, the short answer to that is yes. The designation or compensation levels doesn't matter. What really is the test is what the person actually does. So technically, in a call center, a person who's only receiving calls could technically be qualified as a worker, or a pure operations guy who's not in any managerial or administrative role, you know, can be categorized as a worker. To put it short, a white-collar employee or a normal corporate employee is a worker if the primary role is clerical, technical, or operational in nature, and they do not exercise managerial, administrative, or high-paid supervisory authority. This is an interesting one, and from here on, you will have to actually apply this definition to categorize your corporate employees also in our understanding, between workers and non-workers. And if they get categorized as workers, then obviously the provisions of the OSH code apply. And therein come the rules for leaves. Now, understand, local shops and establishment acts will continue to define the rules because labor is a concurrent subject. So there will be rules in local shops and establishment acts anyways. But on top of it, you will have to take care of these as well. And in case of conflict between the two, we will have to go with something which is more liberal because the law of harmonious application, the rule of harmonious application of law applies. Now, what are the key points that impact us from leave perspective? Are listed on the right side of the screen. Second bullet is where it starts. The code says that leave encashment for workers must be paid on wages. The wages are what we have discussed in the previous section. What will be applicable for gratuity will now be applicable for encashment of leaves for these workers. Now, if you're doing an actuarial valuation, you will have to give separate salaries, for those who are non-workers, and salaries and separate for those who are workers. Those who are workers will be that complicated calculation that we have described in the previous slides. So apart from gratuity, this is the second hit that comes, and it's not just a one-off hit because your liability gets restated up. It also is an increased ongoing cost. So as your leave balances go up, your run rate of cost will also go up. The next, there are 2-3 more things that are mentioned in the code, which will obviously need to become a part of your leave policies. And those are, number one, workers are entitled to demand leave encashment at the end of calendar year. And workers are allowed to carry forward up to a maximum of 30 days from one calendar to year. And leave balances above 30 days need to be encashed at the end of the year on wages. So they don't lapse, they get encashed. And interestingly, the code also says that any leaves applied but not approved can be carried forward without any limit. These 3-4 things are major changes, and when you combine it with the definition of worker, which technically can include your corporate employees. I mean, even if you're not a factory, you could be having workers. Both these things put together, it becomes a material impact on your leave liabilities as well as ongoing expenses arising from your leave policies. Net, from an actuarial valuation perspective, we will require segregation of employees between workers and non-workers, and we will require separate salaries for the two. The qualifying wages will be different. And net, it's not just the gratuity provisions impacted. leave provisions for workers will also go up. Now, having gone through those three key things, one is the definition of wages, then the vesting criteria for full contractors, contract employees, and journalists, and of course the definition of workers and the consequent impact on leave policies. We now go into what is likely to be the impact. Now, the impact is, in our opinion, significant because of the inclusive nature of definition. And even if I were to restructure, how much can you really save is the question. We'll try to go deep into this in the next part of the presentation. But there will be increase in gratuity and leave liabilities. And the extent of that depends on approach to restructuring. There will be impact potentially on PF if you move from PF being deducted and paid on basic to now being paid on wages. Then obviously the contributions to PF will go up, and for the same CTC the take home pays may get reduced. Now, of course, there are some different views that are coming up here. We'll cover that later. But from a gratuity and leave perspective, the provisions will go up, and this will result in a past service cost, which will be recognized immediately in the P&L. We'll discuss the accounting treatment in the next slides, but net worth will be impacted, and there is no flexibility on this increase for past service, as employers cannot do nothing to recover these costs from the employees. So this is an immediate hit. We've gotten a lot of queries as to, is this hit are we live on this part today? Can we defer this till the rules are notified or till more clarity emerges? Our understanding, and we've spoken to a lot of them, a lot of the labor law consultants, also lawyers as well, this definition is live, and you need to take this impact in December valuations itself. But this is not just a one-off increase that will be there in the obligations. You will have increased future service cost, as in year on year and month on month, cost will also go up. An employer can take different views. I mean, the employer can say that, this is additional cost. Let me pass this on to, let me absorb this additional cost because I don't want the take-home pays of the employees to get impacted. This will this may negatively impact the profitability of the employer. Right? This is apart from this one-off that we discussed over here. We're talking about the ongoing costs of gratuity and leave provisions. And of course, if the employer does choose to not absorb these costs or cannot absorb these costs, and it chooses to pass these additional costs to employees, then the take-home salaries may reduce, and this may be viewed negatively by the employee. So overall, in our view, the companies should be very careful in how they analyze and restructure their salary components, so as to balance the impacts on the cost to the company as well as the take-home salaries of the employees. Of course, you also have to keep in mind of what, in any restructuring, what will be the one-off hit of past restatement that will come to your balance sheet. So essentially, this is an iterative process, and I think if you're doing the restructuring of your compensation, restructuring of your compensation packages, then you should consider various alternatives and implications of each from various perspectives, from your balance sheet and P&L perspective, not just one of it, but P&L, but also from employees' perspective. How much take-home pay takes a hit vis-a-vis the increase in the social security components that are there, and perhaps there may be a merit for the organizations to demonstrate that maybe your take-home pay goes down by 5% based on how we restructure, but actually your social security components or your gratuity is actually going up by, say, 10% or 12%. So some of those demonstrations may help the organizations to also sell their approach to restructuring to their employees. So it's essentially a very important part of implementing, very important activity of implementing these codes. Accounting treatment. In our opinion, any hit, I mean, there's a lot of debate that's going on as to the one of restatement of liability that comes in, whether it will go through past service cost or OCI as actual gains and losses. Our view is clear. Anything that's attributable to implementation of this definition of implementation of these codes, that is past service cost and will need to be charged to income statement. There are some arguments being made that, supposedly my monthly CTC was $100, my monthly basic was 40, and I was paying gratuity on 40, obviously, and now because of these codes, I just changed the basic from 40 to 50. This is nothing but a more than expected increase in the qualifying wage, but the qualifying wage, the definition of the wage is not changing. So why can't this go through OCI? Well, your CTC is still at 100. This 40 is becoming 50 only because you're implementing these codes. In our opinion, this qualifies as a past service cost and goes through income statement. In the next couple of slides, we'll look at how past service cost is treated under various accounting standards. There are three standards that we typically end up doing valuations under in India: AS 15, IAS 19 or NDS 19, and US GAAP. Let's look at the treatment of past service cost under all these three standards. The first question we need to answer is whether the recognition is immediate or deferred. Under IAS 19 or NDS 19 as well as US GAAP, the recognition is immediate. In AS 15, the recognition is immediate for the vested component, the vested part of the past service cost. To the extent it's unvested, that can be deferred over the vesting period. The second question we need to answer is where it's recognized, income statement or OCI. In both AS 15 as well as AS 19, NDS 19 or IAS 19, it is recognized within income statement. So it's a hit to your EPS. Of course, you can explain, give disclosures around past service cost and explain it, but it is a charge to the income statement. Under US GAAP, in case of post-employment plans, you can recognize this initially in OCI with subsequent recycling or subsequent charge to the periodic benefit cost or the income statement. Please do note that US GAAP prescribes only the minimum recognition. If the company chooses to recognize all immediately or follow any other systemic approach, it can do so under US GAAP. And lastly, is there any reclassification allowed from to income statement in case of initial recognition is in OCI? That's obviously not there in AS 15 or in AS 19. In US GAAP, yes. Because you're recognizing it initially under OCI, you do charge it back to periodic benefit cost or income statement based on certain formula. To sum it up, for our audience who will be following Indian accounting standards, the impact is immediate and it will be through income statement. Actuarial gains and losses, I'll not spend much time on this. This is just our view is that the impacts will go through our past service costs and will go through income statements. In case it's actuarial gains and losses, if it were to be, it's not the case, and of course it could have been routed through OCI.